Hi, Doug. Good morning, and it's a pleasure to have you here today. For the benefit of our viewers, we have with us Doug Duncan, who is the chief economist at Fannie Mae, here with us to talk about the economic outlook, especially in the light of the recent Fed rate cut of about 50 bips. And it also so happens that the US presidential results are also out, and directionally they are confirming almost a Republican victory at this point. So we'll also like factor in our conversations as we speak to Doug and get his viewpoints on what does it mean for the economy and also some of the major US industries going forward. Welcome, Doug.
Thank you. Good to be with you.
Perfect. So, Doug, why don't we start with the question that is on mind, I think, for major businesses these days. Given the Fed's recent rate cut of 50 bips, like I said, what impacts do you anticipate, especially on major sectors like manufacturing, energy, and technology?
Well, I think that the Fed cut of 50 basis points was a bit of a surprise, and the bond market is thinking about that. And interestingly, when they cut rates, rates have gone up, and that I think is a near-term question in the mind of the market about whether or not that's going to stimulate the growth of inflation again, or whether they'll be able to continue on their path. We view that they will cut rates in the November and December meetings. That's still on their mind. However, the backup in rates in the market, I think, is a concern. And the recent data in the manufacturing space has, for example, by the ISM measure, has shown that it's actually slowed, and manufacturing is struggling a bit. The Fed is looking at a balancing of risks between the slowdown in employment and one of the slowdown in employment versus the the level of inflation. The employment data also reflect the challenge of the manufacturing sector in that the bulk of the addition to employment has been through government and healthcare, and the private sector has grown less. So I think that the Fed would like to see some balance there, some improvement, and perhaps the reduction in Fed rates will enable some trying to think of the right word, some additional growth in employment in the manufacturing space. Sorry about that.
No problem. And Doug, with now slightly lower interest rates, how do you see consumer and business spending adjusting to that in the near term?
Well, from the consumer perspective, one of the concerns has been that the lower two quintiles, the bottom 40% of households from an income perspective, have seen some stress. And in fact, delinquencies on things like credit cards and auto loans have been rising fairly significantly. In fact, the interest rates on credit cards right now are the highest that they have ever been. And so the cut in rates should have some benefit to those lower income households. It's also the case, for example, in the auto sector and related industries, that the level of sales there have been lower than might have been anticipated given where demographics are. But partly it's because the households who would be most in need of making a purchase can't afford the interest rates at the current levels and to make it pay at the household level. So that has held down some activity there. From the manufacturing sector, I do think that the reduction in interest cost will help some of them. Many of them may have actually locked in lower rates in an earlier time period, which are going to expire. And so, to the extent that rates come down some for the refunding, that will help them as they have to refund activity at modestly higher interest rates.
Got it. Got it. And Doug, like I said in the beginning, we are also going to see a regime change now. So, with that, how do you see the policy direction of the new regime affecting economic growth across some of the major industries that we talked about?
Well, I think that there was no shyness in the Biden administration about the fact that they were consciously executing on an industrial policy that is a government advantaged growth in certain sectors. Uh, Jake Sullivan specifically talked about industrial policy being an objective of theirs. I think that's significantly different than what you'll see under a Trump administration. If you focus, for example, on the tax cuts, which will need to be renewed or altered, or some decision made by the end of 2025, that will be much more of a private sector focused execution of fiscal policy. So, to the extent that you are in an industrial area which has been a beneficiary of the industrial policy impetus of our overall fiscal policy, you're probably going to see that recede in the Trump administration, and that there would be more advantaging of a private sector solution. The discussion about the tariffs, I think there's two parts to the tariffs, and this is just my personal opinion. Set aside China, which is more of a geopolitical overall issue, not just an economic issue, but an overall issue. So set that aside. If there were put in place a 10% tariff across the board with all trade, that for two things about that. One is it is a one-time change in the price level. People have been talking about it as inflationary. Actually, just means there's a step up in the price level. Of course, that makes things more expensive for consumers. The idea would be that that would allow for the reindustrialization through the private sector of the U.S. economy. And if you think about the base of the Trump's voters, they've been heavily concentrated in areas that were deindustrialized over time. So this would be a move to attempt to add back to the industrial base in the United States through the private sector, bank lending and capital market lending, to reestablish that as part of our economic structure. The payback to the consumer of the higher costs associated with the tariff would be the increase in employment and the quality of income in the employment that came from that. Now, that's not been explicitly discussed, but I think reasonable inferences could be drawn that that might be the direction that it will be taken.
Right. And Doug, what do you think are the opportunities and challenges that might arise from this new policy and political landscape for the US economic competitiveness globally?
Well, if the U.S. economy right at the moment receives the admiration from the rest of the world. We've been growing at around 3% for some time, which the rest of the world is very envious of that. I think the intent will be to lock that in as a future expectation for growth, somewhere in the 2.5% to 3% growth rate. If that is successful, that suggests a strong future for industrial firms. The consumer side has been carrying things recently, and that's partly as a result of the transfers that took place during the stimulus period during COVID, and with monetary policy offering to households to lock in very low debt costs, those things will expire over time. But if the changes in fiscal policy foment stronger private sector growth and non-inflationary income growth, that will offset the shift away from industrial policy.
Right, right. And with these shifts in both policy and the interest rates, what effects we might see on employment and income growth across like the different businesses in the US sectors?
Well, I think if I've characterized properly what the objectives are, then I would expect to see increased investment and related employment in the industrial sector in the U.S., something that's been heading in a different direction other than the recent industrial policy for some time. So I think that represents an opportunity for growth. I do believe that the value of manufactured output in the U.S. is at or very close to all-time highs. When I say the value, that doesn't mean the number of units of things, but the value of the units of things that we produce. The US still has an industrial base. A lot of it is in very fine technical tools. For example, our steel industry, very high quality products. The machining area, very finely machined, highly useful technical tools, as opposed to sort of a broad base when we used to think about the auto industry. A lot of the auto industry has been automated, and while it's still manufacturing, in many ways, it's final assembly as
Mhm.
opposed to the building of all the components. I think there's some view that bringing some of the component construction back to the U.S. economy would be a portion of the value created in this policy area.
Sounds great, Doug. Thank you so much for sharing your thoughts with us today, and we look forward to continuing our collaboration with you.
Yeah, we'll see how it works. We've just begun, so good to be with you.
Thank you.